so much for that kind introduction. And good morning, everyone. Welcome to finally kick this off. Very, very excited to be able to start off. And so I don't know about you all, but I feel like over the past maybe year, 18 months or so, the word tokenization has kind of taken on a mind of its own. It means a lot and means nothing all at once. So I thought I'd kick it off by just giving a quick overview of how I look at the term and what I think makes tokenization different from previous networks. Really what it comes down to is, for the first time since tangible money, we are finally reconnecting information and value into one token in a way that we haven't seen. So today, as you all know, if I were to swipe my credit card, the information would be transmitted instantly, but the value, of course, takes 2, 3, 4 days to settle. With tokenization, you're finally combining that information and the value together into one. And while it can be used for payments, it can be used, as you know, for pretty much any other asset that you can throw on chain. And as all of you know in this room, there are many benefits here. You get that instant settlement that eliminates that stat risk. You end up with programmability that allows for customization and use cases that we really don't. We are just scraping the surface of what we really think is possible here. You end up with that lower cost structure that we all like, and you get to create new products. And the implication here is, ideally, with this lower cost structure, of course, you get to access, you get to push capital and increase access to those who are seeking it. So I guess this next question is, okay, so we made it, right? I mean, look, we're tokenizing T-bonds, we're tokenizing currency, we're tokenizing real estate. We did it. Actually, these are from 2017 and 2020. So I think it's really important to think about kind of where we're coming from and how much progress we've made, but also as a reminder of how much is yet to come. And so really the question then becomes, well, what makes this different? What is in 2024 truly different from the previous cycles? And kind of what fills this room? What makes people want to finally think that this year is the year that we can really be able to build and take off in the industry that we really think? And what it comes down to is these 5 guys and the industries and the organizations that they represent. The Fed, the industry, regulators, and then the innovators in the space that are really pushing the envelope. So when we think about, okay, what's truly different in this cycle, the first, of course, as we all know, is central banks across the world have all raised rates, meaning that the time value of money is much, much higher than it previously was. So suddenly, instant settlement really means a lot to a lot of institutions. As well as, in terms of on-chain interest, is now very much in demand because in the TradFi world, you can get 5% risk-free. So as a result, many companies, I think BUIDL product is a good example with Securitize and BlackRock, really innovated quickly to realize, okay, if we want to keep people on chain and get the next iteration of people on, we need to be able to have that risk-free rate as well. And then, of course, on the regulatory side, the Bitcoin ETF in the United States has really taken off. When all 11 were approved in January, as you all know, the inflows broke every record of any ETF in history by a long shot, and every estimate was completely blown out of the water. So the demand here is very, very high, and we've seen similar indications from the Ethereum ETF, which, as you all know, just through the different rumors, it looks more and more like it'll likely be approved in the coming months. And I think we also have to really credit the industry as a whole in terms of how much better the user experience, how much better the technology, and how much better the underlying applications that we all use in this space have improved since the previous cycle. And so I think that's really one of the bigger differences here is just thinking back to 2020, the different apps we used on the DeFi side or on the institutional side is just very different. It's much more user-friendly and much more likely to make it easier for people to make the jump from TradFi to crypto. I also think that the regulatory side has begun to shift. I mean, as an American, it's pretty easy. I mean, I'm in Frankfurt here for many reasons, but one of which is we've seen so much capital flow to the EU because of MiCA and because of the power of it, and finally being able to be given rules of the road in a way that on the other side of the Atlantic, we're very much still deciding and in the discussion phase of creating the regulations that make sense for this industry. So it's very clear that while we have a long way, that progress is very much happening, and we see that as a large indication of the direction that we see this going. So that's all really what makes this year different from previous cycles. And I think it's important to note that I don't mean to indicate that from here it's all up and to the right. I mean, anyone who's been in this space long enough knows that it'll go down again. But what's important is that when things are going up, we go 2 steps forward, because we know that eventually we'll also go 1 step back. So I think one thing to note in terms of this this kind of energy that we're seeing, it's indicative when over half of Fortune 500 companies are really beginning to use this technology in different ways. And as we know, it starts with small pilots. It starts with those small research teams and those smaller groups that begin to kind of build the story and build the data set to be able to give executives the decisions to be able to allocate more capital to this space. So when I think about the market today, I really see 4 main buckets. The first, of course, is stablecoins, far and away the biggest product market fit, with over 160 billion AUM. And of course, those fit into 2 buckets. First is a means to be able to trade Bitcoin, Ethereum, and other crypto assets. The other side is for people in emerging economies or in economies with weaker currencies, and they want to be able to maintain and grow their wealth by accessing the US dollar. So those are really the 2 main use cases for stablecoins so far. I think those will definitely increase over time, especially as stablecoins become more integrated into the financial system as they are given regulatory clarity, where an on-chain euro and an off-chain euro can be looked at as identical. Then we get to tokenized money market funds, which, of course, I think we've really seen a vast increase there with BlackRock and Biddle, Ondo, Superstate, all of these companies that we've really seen grow over the past really 6 months to a year, because that on-chain currency and on-chain interest rates really allows people to now stay on-chain in a way that they can. Instead of using it as a means of payment and then jumping back into TradFi, they can stay on and continue to grow their wealth. And then this bottom left category is quite entertaining. It's what I would call just the unique high-value assets that are the flashy side of crypto. So you think of the Watford soccer team that Republic announced a week or 2 ago that they've tokenized 10% of it for retail, for fans to be able to engage and own part of the team that they cheer for. And then, of course, I thought I would highlight as well that Galaxy actually recently tokenized a Stradivarius violin from 1708. We had a client come to us who talked about how the collateral that we were using before, Bitcoin, Ethereum, and other crypto assets, was quite volatile. And so he said, well, I have this violin, and by putting it on chain, it means that he can get a much higher TVL on the loans and the financing that we were offering him. So really, that's the idea. Is we see all these different assets, we see these different utilities, and what they really do is drive the narrative and make people think differently and make people think, okay, this doesn't happen in normal TradFi, so there must be something here. And that kind of gets us to the pilots and the proof of concepts, which to me is, I think these are earliest on, but at the end of the day will likely have the highest impacts. Because you see the Regulated Liability Network, Project Guardian, the KKR fund that was tokenized on Avalanche. And while they very much are in project and pilot mode, those final reports do catch the eyes of senior executives, and they do change the direction in the long term of capital allocation between these major firms. And I think we see that with, Onyx is a great example where Jamie Dimon is known to be a comparative critic of the space, yet Onyx has hundreds of people working at it because they recognize the power of the underlying technology and the way that it can be integrated into the space in a specifically advantageous way just for traditional financial products, let alone the future financial products that this technology enables. So the takeaway is we have a handful of real parts of product market fit, and we have a long way to go. But this alone is quite impressive and has delivered clear utility to different users. So I think one thing to note is, well, then what happens 5 years from now? Where will we end up? This most recent stat I thought was telling. 16 trillion, of course, is a big number. And I think the question becomes, how do we get there? If I were to give this presentation 5 years from now, I guess 6 years from now, would we really be able to get there? That's the question. I think we will. I think it'll have ups and downs. It'll be sinusoidal, but it'll very quickly become exponential at some point. So I thought I would do a quick deep dive in all things on-chain currency. First, because it has the biggest product market fit, but second, because whether for better or for worse, I've spent way too long in this little niche of this space. Was at the Fed on their CBDC team, was at Ripple, then was at Paxos, helping work on the PayPal stablecoin, and now work at Galaxy and in partnership with Flow Traders and DWS are working to launch the All Unity stablecoin. And so I've spent a lot of time looking at this space, and so the question to me is, how do we see the future of fiat currency on-chain? I really look at it in four main buckets. So stablecoins, real-time payment systems, central bank digital currencies, and bank deposit tokens. And stables, we discussed already. These are digital bearer assets, which have clearly shown utility. I think the real question that I have here is, what does the growth trajectory really look like? Because, frankly, because they have to be fully backed and they change the nature of fractional reserve banking, at scale, it makes it much harder to actually have the economic impact at a massive scale compared to other means of payment. One example I would think of is, so right now the market's 150 billion. It's not too hard to imagine that could 10x. If that does, of course, that's 1.5 trillion. Okay, so back that with 80% of T-bills. The entire T-bill market in the United States is roughly 6 trillion. So that would mean that a quarter of the entire market would suddenly be sucked up by stablecoins. And as a former central banker, to me, that kind of gives me pause. So we know that while stablecoins have large impact as a means of payment, as a store of value in the longer term, they might face competition because the scaling challenges associated with them. In terms of real-time payment systems, we've seen clear growth in different countries. We see there are over 40 real-time payment system networks domestically all over the world. We've seen clear growth with UPI in India and PIX in Brazil. FedNow in the US that was launched last summer continues to see growth. And so real-time payment systems aren't going anywhere. It turns out we don't have to tokenize everything. I think they do have utility in the longer term. And then we get to CBDCs. And these are pretty interesting, especially in the media in this industry and on Twitter. I think the discussion can become quite lively, to put it one way. And I think the takeaway there is I was on Project Hamilton, which was the retail CBDC team at the Fed, and there were a few takeaways, but the biggest one is if you look at the roughly 140 different central banks all over the world that are looking at CBDCs, the vast majority of them don't actually use blockchain. So I'm going to say that again because I feel like a lot of people forget that most CBDCs don't actually use blockchain, and that's for a few different reasons. In our case, it was simply because if you look at the throughput required for some of the biggest economies, blockchains simply don't have the ability to handle 1.5, 2 million transactions per second. For context, Visa is between 6,000 and 10,000. They can handle up to 60, but on average, they're around 6 to 10,000. So that difference is quite large. So most of these CBDC projects don't actually use blockchain. And then you look at their design, and because no central bank wants to directly face their users from a retail perspective, you end up with them being fully intermediated. So then they end up permissioned. So once you follow that logic tree, the utility of a retail CBDC wanes substantially to a specific niche use case for digital cash. So then you end up going down the wholesale route, which has utility. You get the instant settlement, you get the programmability, but it becomes just like another faster network through which the traditional banking system can work. And then we get to deposit tokens, which to me, I think these show a lot of promise. There's still a lot of design questions. You look at Onyx with JP Morgan Coin, or you also see Citi Token Services as well. And they really are doing a great job of innovating and thinking about, okay, how do we actually do this? How do we put our liabilities on chain in a way that balance the innovation that this technology enables with also the KYC, AML, and regulatory requirements that can be comparatively challenging. So while you can look at all of these verticals and they all have, pros and cons, the big takeaway for me is not one of these is going to dominate. It's not going to be stablecoins as the only way that you move and store the euro or the dollar going forward. It's not going to be just CBDCs. It will be a combination of all of these. Just like today, if I were to send money to someone, there are probably over a dozen ways I could do that. And in the future, that isn't going to change. These will just be new avenues, new ways through which to move value, but it's not going to upend the system in the way that I think a lot of tokenization advocates think about it. Instead, these will just be new ways to move the same value. So as we move on beyond stablecoins, I thought I would share this graph because it highlights the diversity of assets that we put on chain and the progress that we've made. You can see, commodities, securities, all kinds of things we've thrown on, private funds. But two things to take away. First is I was surprised by the lack of equities and private debt, and then also real estate is quite small compared to kind of the amount of buzz that it's created, because it has so much potential, but we really aren't there yet. But the biggest takeaway to me is you look at the y-axis, and it's 3 billion total. So it's 1/50th of the stablecoin market today. So we've made tremendous progress. I mean, we've come from literally nothing just 4 years ago. But at the end of the day, 3 billion in the financial system is a rounding error. And so we've shown this growth and we have this potential, but truly we have so much left to go and so much green space, which is also why it's so exciting and why conferences like this are so key, because we're just getting started. And the question is, again, 5 years from now, whether this graph, we think it will be linear or whether it will be exponential. My belief is I think it will be exponential with some clear bumps in the road, but we will see. We'll see. So in terms of how I see tokenization going forward, I really bucketed into these five categories. And I guess one thing I would note is making predictions is always quite challenging. Making predictions in this space, pretty much impossible. So I'm taking a risk here, but this is kind of how I see the world unfolding in this next cycle. So stablecoins we already discussed have clear product market fit. Money market funds are very much there, and we'll see substantial growth. And I think what's fun about money market funds is, of course, they're at the end of the day just on-chain debt. So we have dozens of teams and hundreds of millions of capital, billions of dollars in capital, figuring out how to put debt on chain. And they're starting with the risk-free rate of all these different government bonds. But as we know, quite quickly, that fee will be compressed, and that margin will be brought down to zero. And so we'll see a lot of these teams, a lot of these companies pivot down the risk curve and go farther out seeking greater yield. And so I think over the next 6 months to a year, we'll see vast growth in on-chain debt specifically across different parts of the debt market, because all of these companies and all this talent has learned how to throw money on chain from a debt point of view, and now they can do so across different parts of the industry. Then these last two, I think, are comparatively farther out in terms of real scale. From real estate, I think a big challenge here is the fact that it is comparatively local. And so it's just subject to specific regulations that other parts of the industry are not. And then equities, at least in the US, for a typical equity trade. So if I were to go onto my E-Trade account and buy Google stock, there are almost a dozen different intermediaries that actually touch that transaction between when I place the order and when it actually settles. And taking that system apart and making it more efficient is just going to take a very, very long time. I think it will happen. But I think the adoption, and from a regulatory point of view, there are many more challenges here that I think will take a comparatively long time. But the takeaway is for these five is if you look at that, I don't know if we can call it a graph, but the line on the right, you see that it's exponential, but has ups and downs. And we know that we'll almost certainly go through that same wave that we've seen. We've already seen this happen multiple times, and just what's important, as I mentioned earlier, is we will have our ups and downs, but we just need to make sure that when we have the ups, we're making as much progress as we possibly can, so that when we take that step back, we only take one step back instead of two. So I guess I'll end with, given that's a potential roadmap for the potential of the industry, what can we do as an industry today to make sure that that vision is really brought forward into the 2020s instead of into the 2030s and beyond? And to me, these aren't rocket science, but I think a lot of the time, especially when we're talking with large traditional financial institutions, people talk about how this technology is truly revolutionary and can transform the way that we store and move and access value. And while that's true, what's important is to have the conversation be about how it's evolutionary, how we can help these large institutions make small steps every year over time so that a decade from now they can look back and say, oh, wow, suddenly half of the financial transactions that we engage in are actually on chain, and they wouldn't even realize. Whereas, in some of the previous places I've worked, if I were to say, hey, I have this revolutionary technology, let's change and upend the entire system of an existing company tomorrow, the leadership would say, absolutely not. We need to take baby steps. So that's the first one, is really to slow down and think about what incremental change we can make. In terms of focusing on the TradFi potential, I think these pilots are quite key. They may seem like just another research paper, but what they do is it means that the leadership of these large institutions can reference these different numbers that we have. That 400 billion report from Bain, I think, is one that people often cite. We need more of those, so that it's not one or two, but dozens, where suddenly the data set upon which to make these decisions grows so large that it's inevitable and looked at as not just a blip, but really a focus. And one thing to highlight there as well is looking at these major institutions. I think in the past cycle, each company maybe had a handful of those blockchain guys in the corner. I can say that because I was one of them. But now they look at it and they're massive teams. Across all the biggest firms, all have big blockchain teams. And that is completely cycle agnostic. Whether high or low, they see the utility there. And I think that's different. And that is something that we can really focus on, because it's clear that capital is being allocated towards this technology in a way that previously we haven't seen. Embracing regulators, I think, is something that we've talked about a lot in the US. Can be quite polarizing, whether to kind of really work with regulators or whether to kind of stand up and try to show kind of what parts of the industry we think is correctly regulated or not. But at the end of the day, it just comes down to education. And as we know, it takes a long time to learn this technology. For me, I've been in the space for 5 years at this point, and still I'm constantly learning because it moves so quickly, and there's so many different applications of it. And then finally, of course, what we do want to do, of course, is begin to separate the technology of tokenization and TradFi from the crypto side. And while I don't mean the the energy, I really mean just the conversations. Because I think with regulators and large institutions, crypto can be looked at, as a bad word, but tokenization is much more celebrated. And so I know this conference is all about tokenization, and so that's one thing that I would really highlight is focusing on what this can do. And so just to kind of wrap up, one thing I would note is this is where the industry is today, but the question is, it's completely up to us in terms of what we want tomorrow to look like and what we want that on-chain adoption to really look like. So with that, I think I have roughly 5 minutes for questions, if anyone has any questions.
Thanks a lot, Thomas. Very interesting insights, especially showing how tokenization has arrived again, but still not yet truly and fully. Very interesting. We have a couple of questions from the audience. I would like, also with respect to time, take one main question out of it. Maybe have time for a second one. First one, what's your take on Europe and what's the business opportunity also for Galaxy in Europe? And I should tell you, we can take the truth.
I think the biggest, obviously the US market is quite large and there's a lot of, a lot of capital in this space and a lot of innovation happening on the other side of the Atlantic. But one thing that's very clear is the regulatory clarity that is coming with MiCA is a true game changer. And I think I'm a good example of that, right? Like I'm born and raised in Boston, work in New York, but here I am in Frankfurt. And I think that's one thing to note is you look at the innovation happening in the UK, in Germany, in France, and the conversation is just very different in terms of talking to you all, the different companies that you're innovating and creating. It's just so much farther because you're finally given the rules of the road that allow you to innovate and know that regulators will give you the green light in a way that the US we're still comparatively exploring, I will say, how to find those rules and how to make sure that we are on the right side of what's allowed and what isn't.
Thanks a lot. A second question that came up is with regard to stablecoins. What would you think with regard to interest rates once they drop to zero, even below zero as we know it in Europe? Do you see, or how can that impact the whole industry?
Yeah, so it's kind of a double-edged sword, right? Because the higher the rates, the more money that stablecoin issuers can make. But of course, the higher the likelihood that a stablecoin holder will look for an alternative because there's an opportunity cost for the yield. The flip side is, of course, when rates go down, people are more likely to keep their money in stablecoins, but the underlying company might make less revenue. So it really just comes down to the demand curve and what that looks like. And I think what we'll see, similar to if you look at USDC's growth and Tether's growth over the past 2 years, roughly, those who are banked and are in comparatively developed countries, we've seen that when rates have gone up, they have shifted from using USDC to going back into TradFi when they can to access those rates. Whereas with Tether on the other side, because it's used by far more in emerging economies where people are really looking to access the US dollar, they are less likely to be banked. So as a result, they're willing to put up with the opportunity cost of losing, 300 bips, 400 bips, because the alternative is being in a local currency that is getting rapidly devalued. So I think it really comes down to kind of the adoption curve that we see and the real utility that we see. One thing that I find interesting with stablecoins specifically is the main use case today, or one of the biggest ones for stables, is a means of payment. But the underlying revenue potential for the company is actually as a store of value, which is an odd dichotomy because, obviously if you're making a company, you want to make sure that the utility that you're delivering to your customer is also exactly how you're making money. Whereas with stablecoins, that's a little bit of a disconnect. So I think once we see regulatory clarity with stables and they become more of a means of payment, the business model underlying it will change because it will be that much easier to get in and out and on and off on chain because the on-ramps will be much smoother. So you might see a comparative decrease in revenue in the short term, but I think that will be more than made up for by the volume that we'll really see. So I know that's a long answer to the question, but once I start talking about stablecoins, it's a lost cause. So.
Well, thanks a lot, Thomas. It was great having you here, and thanks for your insights and all the additional questions you have. Please also feel free to ask Thomas directly. Thanks for being here.
Thank you so much.